Trading with trend lines. In this video you will learn what a trend line is, the correct way to draw them, and how you can trade using trend lines. Trend lines are useful for structuring price action. They can be used to help identify the current trend or help confirm a reversal of the current trend. If the price is under the trend line, then the overall direction is down. If the price is above the trend line, then the overall direction is up. When the price breaks through the trend line, it is likely that the price is now reversing direction. Trend lines in a downtrend are drawn by connecting at least two highs with a line, and trend lines in an uptrend are drawn by connecting two lows with a line. The more times price touches the trend line, the more valid it is. It is not necessary that all candles are below or above the trend line, as long as the vast majority are. Furthermore, just as with the support and resistance lines, you can choose whether you use the bodies of the candles or their wicks as the basis of trend lines. There is no right or wrong, it just depends on what works best for you. Trend lines can be traded in two ways, either by entering when the price finds support or resistance at the trend line, or when the price breaks through the trend line. In this case, we are going to observe both ways to trade using trend lines in an uptrend. First of all, you can trade the bounce of a trend line. This means that whenever the price touches the trend line and finds support, you can place a trade in the direction of the trend. Since this is an uptrend, you go long when the price touches the trend line. Your stop loss would go on the other side of the trend line. You can also wait for price to break through the trend line and trade the breakout. In this case, you wait for the price to break through the trend line and go short. You can use trend lines in the same way when the price is in a downtrend. Whenever price touches the trend line and finds resistance, you can place a trade in the direction of the trend. In this case, a short position, as the trend is down. Your stop loss would go on the other side of the trend line. Or you can also wait for the price to break through the trend line and trade the breakout. In this case, you wait for the price to break through the trend line and go long. Again, you put your stop loss on the other side of the trend line. Bear in mind that when you are looking to trade using a break of the trend line, sometimes the breakout can be false. The price just temporarily crosses the trend line, but then resumes in the direction of the previous trend. To prevent you from entering on a false breakout, wait until price closes below the trend line and comes back to retest the trend line from the other side. In this case, you wait until the price breaks down through the trend line and closes below the trend line, and then wait for the price to come back up to retest the trend line from the other side. When the price does not cross the line again and continues moving down, the price has successfully tested the trend line and confirmed that the breakout is not false. You can then enter into a short position. This concludes the Trading with Trend Lines video. So far, you have learned that trend lines are support or resistance lines drawn at an angle. They are used to show the current market sentiment and find entry points for trades. You also learn that to draw a trend line in a downtrend, two highs must be connected by a straight line. To draw a trend line in an uptrend, two lows must be connected by a straight line. Furthermore, you saw that the more often price touches the trend line, the more valid the trend line becomes. And you also learned that you can trade the bounce and the breakout.